Good morning, ladies and gentlemen. This is Real Estate Trading Frank. It's approximately 10:11 a.m. We have a time change, as you know. We're back to standard time, I guess. I never get used to these things. It is 10:11 a.m. Eastern Standard Time on November 4th, 2018. And we are going to whiz through a bunch of very important actionable charts and a few words of what we need to do. And of course, we have our nightly weekend session set for 8:30 p.m. approximately around that time tonight. Once the futures open for business, and we have a little bit more clarification as to what might what will happen the following day. So you get a double bonus today. Lisa, if you don't mind, if you can turn the volume down a little bit on your end so we get a little less feedback. And of course, make sure that you have visual and audio connection. So on that note, let us begin. So before I go any further, we have the screensaver in the back with the Google YouTube channel. As you know, this session will be recorded and uploaded to the Google Real Estate Trading Google YouTube channel for viewing by any members or subscribers, as well as anybody out there with the internet connection. These are very valuable video casts on forecast, market comments, analysis, and what I call predictive analysis, which works quite well despite the intense extreme volatility that we are incurring, and I believe will be incurring going forward. One other quick plug that I always do, our Instagram account is going slowly but surely, and certainly visit that and follow it. There are some fantastic highlights of our trades, charts, things like that. At the end of the day, primarily for promotional purposes, to spread the word of real estate trading out there in the online universe. And it certainly is helpful when everyone follows and have their friends and colleagues also do that. On that note, full disclosure, this is purely for financial education and not for any solicitation or advice. And looks like we have one other terrific member who's going to be joining in, and I am going to put in the link, and they should be joining in any minute. So before I go any further, what we are dealing with in the markets, which we all know, nothing new about that, is this. We are dealing with sharks, big sharks, and these are primarily the algorithmic high-frequency trading black box programs, which dominate the market literally every minute, every hour, every day, every week. Markets do work on fundamentals, and we all know that. However, fundamentals are more of a slow-moving big whale, and the sharks and the algorithmic high-frequency trading, what we call algo HFT programs, are the fast-moving sharks, which go in and out of the market, buy-sell programs, creating extreme volatility, what we call structured volatility. What we try to do here at Real Estate Trading, as you all know, and I'm stating the obvious, is we try to work on constructing charts which will give you a pretty decent idea of what could happen if the markets pull back, and how you can benefit from the long-short type of trading that we do, primarily on the long side, as you know, and catch those massive 600, 800, 900 point moves. Do some intraday shorts on the quick 200, 300, 400 point pullbacks. Prime example was on Friday when I told people to basically go short, and those things just took off like a rocket, and they were intraday SPY puts. And of course, you can use any one of those, other vehicles that are out there. You can buy VIX calls. You can do any one of them. You can buy leveraged ETFs, which are on the short side. Whichever way you want to do it. But that was put in very clearly, and as you know, it worked out fantastic. Not only did we go short, we took down a tremendous amount of profits on the market open, and we have done this quite repeatedly, day after day, and protected. And as I said, raise cash, simple terms for sell, your profits, sell full or partial profits. You might want to leave a small position in there. That's completely up to you, or go completely out, and keep that cash on the side to be used going forward, if either that day or on the following, or set up trades intraday, or you can always leave it for the coming week. You don't always need to be fully invested. Traders have to understand that there is no harm whatsoever, especially in these extreme volatility, especially with what we are coming through right now with the midterm elections. That I've said, there's going to be pretty massive volatility going into Tuesday, and there's going to be volatility after Tuesday. But then the market's going to sort out, and we're going to mention a couple of things, and I'll go further into that on tonight's session, as to what we can expect going forward this week, and going into mid-November. Forecasts are primarily short and intermediate term. This is not the type of market where you can make a very sharp long-term forecast. I can give you a very strong bullish case. I can also give you a bearish case on why what will happen over the longer term, which means that over the next, let's say, 3, 6, 9 months, but as tactical traders, we take full advantage of what is going on now in front of us, and we do very well. So on that note, biggest things that we have to watch out for this week, which we know, is the midterm elections. Then we come into the middle of November, where we have the President Trump, Premier Xi meeting at the G20 summit, and in Argentina, I believe, and he's expressed his desire that he has spoken with President Xi, and we'll see whether there's going to be any sort of moderate outcome, or at least what would be extremely bullish for the markets. I'm going to be just flipping to the charts as I'm talking, so it's not a static screen. And good morning, K-Bot and Sarm, for coming in. So bottom line is that we will, what would be extremely bullish for the markets would be a resumption of serious negotiations. There are serious negotiations going on behind the scenes. I'm absolutely convinced about that. That's just the way, life works. That's the way politics works, and especially between two big superpower type of countries, and us being the, big daddy of all. So there are talks going on between the Chinese and the U.S. But a formal announcement from the press release after the G20 quick meeting between President Trump and Premier Xi, that they are at this point going to start some serious negotiations, would be extremely bullish for the markets. And we know that any type of tweet coming out that he actually spoke to President Xi, which he did, as he mentioned, boom, the market goes up 200 points. And these things expected, expected. A tweet coming out saying, well, he's a little bit disappointed in the way President Xi is conversing with President Trump. Markets will be down 200. So that's the reason, sole reason, why these tactical charts are of immense importance. Saying all that, I have some great news. Okay, the great news is, it breaks down into two aspects of it. One, there are traders in our group who are doing extremely well over the past couple of days, not even weeks, since we bottomed on the 29th, where we had that massive hammer reversal, all shown on my charts, alerted to all of you. On the 29th, we have had a 1,000 plus, or somewhere around there, I don't have the exact number, on the Dow Jones rally. Big. We have had traders who have participated in portions of that, traders who have participated in a good part of that, what I call the 3 marching soldiers. And this was Friday, where we have a doji. You can see that right there. This is the E-minis we're talking about. And that's a doji. That's a classic doji right there. Hit exactly the level that we talked about, which was a 2766 level, 200-day moving average. We'll look at that chart too in a minute. And we pull back. We came down, we retested the 50 Fibonacci retracement right there. Right there. That's the 50 Fibonacci retracement right there. There we go. Daily chart. And we kissed it, and we went up. And we ended with a doji candle. Do study the candlestick pattern videos on my site under new member introductory videos. and the candlestick pattern playlist, as well as go on Google and listen to one of the great, all these great candlestick traders who can explain this stuff better. But doji, in my opinion, and I'm a pretty simple guy when it comes to that, it means indecision. And that indecision, big money was made. We sold right around, going on the pop. Uh, that's known as simple trader language pop, which the pop was a technical move up to the 200-day moving average, and then we pull back, and that can be clearly seen in this chart here. You can see that we kissed it. I mean, you can't get any perfect than this, and I've been talking about this for days now. So since this move, a good number of traders have done very well. Small accounts can get big. A couple of $1,000 accounts, or even small, let's say $1,000 account, can generate up to 4,000, if not more, on these type of tactical moves. And you don't have to hold it from all the way down here. Let's say you never didn't buy here. You could have bought here. You could have scalped the whole bunch here and managed your trade accordingly. Or if you have a small amount of money, throw it in. You say, that's it. I'm going to go with it because this looks like a very formative bottom right off the bottom end of this wide macro channel. And I've consistently talked about this stuff, shown it intraday as well as pre-market and end of the market charts, which are very important to see the closing from a technical standpoint, not just from a price standpoint. And it gives you a really good idea. Not to mention that the next morning you could wake up and futures could be down 20 or it could be up 30. But saying all that, the fact is that it hit the bottom end of the channel, and if you had a small amount of money that you throw in there and say, that's it, I'm going with it, and it looks very likely from a probability standpoint, from a technical standpoint, which I was dead correct on, that we were going to hit the 200-day moving average exactly around 227.66. And at that point, that's a major resistance. Well, you made a lot of money. The second part of the good news is that people who did miss out, and let's say, of course, the emotional aspect is extremely important, the mindset part. And I just want to talk about that for a quick second here because I don't want to get into it too much. The behavioral game theory and the mindset of a trader or an investor, whether they're risk orientated, whether they are somewhat risk averse, is extremely critical. Extremely critical. This is a risk market. In other words, you make a lot of money playing risk through these charts. And if you're very risk averse, you're not going to make money, both on the long side or the short side, because every single price movement and the algo HFT black box manipulated structured volatility is going to keep you so scared. If you're just watching prices, then you are not going to take any step forward. So you have to embrace risk within a quantifiable form. And the only way you can quantify risk is not by seeing shooting numbers going up, Google's going up to 10, 20 points, pulling back 10, 15 points, all that kind of stuff, the intraday volatility that we incur, but to focus harder and harder, and it's not hard, believe me, on my structured charts that I put out there, and also the numbers and the comments and everything that I put out there. Mix it in with your own skill set. Everyone has their own style, and you will make money. So the great news is that people who totally missed out on this level, in my opinion, will get another chance to get in at some really cheap prices. Okay? So in other words, what I'm saying in simple English is the markets will pull back again, and we have a fair shot of retesting this 2600 to 2625 level, or maybe even slip a little bit lower at a massive crash type of pullback around 2550. That means the market could be down another 1200 to 1500 Dow points, going all the way down here within the next 2 weeks. So that's a great news, because nothing is more sweet, and you guys all know that. Buying, I'm just going to say I'm sticking to SPY and SPY calls here because we're showing the E-minis, at $1 or $2 and selling them at $4, $5, $6. And the nature of the beast is, and the algos don't make it easy, is they read everything that's out there. They see the stop limits that are put out there. They see the sell limits that are put out there. Once you put up a physical stop loss or a sell limit or anything out there, okay, in the matrix, they see it. And within a nanosecond, they analyze it where the crowd is hanging, where the fear buttons can be pressed hard, and they will jam you on that. Get too excited, they'll jam you. People who got too excited at the 2760 level got hit hard on Friday, and we were selling hard, and we went intraday short for a couple of hundred intraday ROI on the SPY puts. And for some people who are not members and listening to this, feel free to join us as a free trial or paid member, and you can see all those precision alerts, numbers, charts, real time on our private Twitter feed at Clueless8RT. So we welcome you to join us and see the magic that happens. So the key is the second part of the great news, which I was just explaining, is that we'll get another chance if from the long end, and we will and we're not going to just wait around and say, okay, the markets are dropping, it broke below all these structural levels, and we're just going to sit there. No, we're going to short. My shorts are going to be primarily on an intraday basis, and we're going to make money. And once it hits there, it could slip and slide, could go lower. We'll see. A lot of the internals that I follow and some of the simple ones that I show, the stochastics, the McClellan oscillators, and the ultimate canary in the coal mine, which is the VIX, playing the VIX pair trade, VIX long or short, SPX long or short, right? It's a inverse correlation. And the VIX charts, which I have shown repeatedly on using the quad. I'm going to pull up this is the basic VIX chart. On the quad algo HFT system, I literally know by looking at those candles on the VIX, not necessarily on this one. This one I look at a more broader view. But on the quad, using the quad QUODD, and I show it on real time. But if you subscribe to Quad or do a free trial with them, which I always recommend everyone to do, you can see it directly. You don't even need me to tell you that every one of those candles will give you a directional bias as what is going to happen. And you start reading the internals on the 15-minute, on the 1 hour, on the Quad system, not this one. You will be able to manage your trades like an efficient robot. Really. And you won't be held hostage to just watching the price and losing money or missing out great opportunities on the long side, which is the same thing as losing money, is because you didn't make that. So saying all that, the VIX is going to bounce. The VIX is going to bounce off the 1969 level at this level. If you look at the daily chart, we were talking about a negative divergence starting when I saw this, and that was back on, what date was that? That was the 24th. 24th. That was a long time ago, guys. All right, the 24th of it was 2 weeks ago that I kept on showing that there was a negative divergence going on the internals, while the VIX was creating this was where the VIX. This was where the VIX peaked on. The VIX peaked on short-term intermediate peak on the 11th of October. It went back to almost retest that. Well, it did retest it. It did almost retest it. And that was on the 29th of October. Yet the internals, which I showed prior to that, starting on the 24th, were showing there was a negative divergence in play. And that's exactly what happened. So despite the intraday volatility, the daily VIX, forget about the 1 hour and 15 minutes, which is very extremely important for tactical traders, but even the daily VIX was telling us that, you know what? We're going to throw out every single retail emotional traders off the boat, but we're going to take this market higher. But in the meantime, we're going to scare the living daylights out of you through structured manipulated volatility, and we're not going to make you any money because you're not going to be in the market. And that's what happened to the majority of retail traders out there, and with some of our traders. I don't know. Maybe some of our traders not. I don't know. But I'm just saying, that's what I feel. The level of fear generated, machine generated, because these are, after all, mindless machines, is the ultimate form of mental manipulation. Fear is not to be feared. Fear is to be conquered. There's an old saying from way back: the beginning to conquer fear is the beginning of wisdom. That applies to our life and that applies to trading. And it's just, the way I look at life. So once you start to conquer your fear a bit, you get better at not panicking. And panicking comes in two aspects. Panicking comes in just selling at the wrong times. And panic also comes in when you don't buy at the right time. And like I say, the pain of regret is really far more painful than the pain of sacrifice. And sacrifice is to follow the charts, have some position in there so you can enjoy those 900,000 point moves to the levels that we showed and make some substantial money and feel great about the fact that you can still make money in intense volatility despite all that is talked about in the media, all that big hedge fund managers are losing money right, left, and center. And we are having solid weeks back to back. In fact, last week was very solid from a profitability standpoint. And once you get that type of confidence instilled in you, of course you're going to be scared. I'm scared too at many times. But playing moderate to smaller positions and scalping the profits is really what trading is all about. And let me just point out one very important thing. Yeah, I mentioned that in my previous video. This ain't going to change. This is the way it's going to be. So going back to it, this negative divergence that I kept on showing, kept on repeating with my comments and such, played out. Now we're approaching the lower end of the stochastic range. And this works 100% of the time. Literally. Okay, 90 to 100% of the time. Not just on the VIX, on anything. Now we're approaching this. We don't know whether we're going to bounce from here or whether we're going to slip and slide a little bit more. But once we get to these extreme oversold levels, you know what's going to happen. Yes, the VIX can slip and slide all the way down to 1969 or 20. You know there is going to be a reflex bounce. Just the way we get reflex bounce on the stock market side, on an individual stocks, you get reflex bounce on, this is technical charts on the VIX. The VIX tends to move very fast, very furiously, because it is a wild. It is, I shouldn't say use the word. It is a derivative. It's a mathematical derivative. And of course, it moves very quickly. And of course, with the tweets and the news flow and stuff, immediate action. Extremely important to watch that. I have a phenomenal video on the VIX and how to trade the VIX versus the S&P, or just trading the S&P on the SPY and the SPX by tracking the VIX. If I can do it, anybody can do it. It's not rocket science. And in fact, those are the only two charts that you need to tell you what the markets are going to do. Okay, so saying all that, let's get prepared, mentally prepared, as well as technically prepared to have a super volatile week and come out at the end of the week with a big smile on your face and big greens on your P&L. You know, I love my members. I push hard. I try to motivate myself as well as my members as much as I can. And I try to be a performance coach because that's what my biggest challenge is myself. Am I completely very excited and happy about what I did over the past couple of weeks, past month or two? Yeah, I'm excited. I'm happy. Am I really ecstatic about my performance? No. I could have made a lot more. A lot more. So I have a lot of room to move. I'm working, and it's a fact, maybe at 60% peak performance. Ask yourself the question, at what peak performance are you guys working on? Are you working at 10%, 0%, 20%, or are you working at 80%? I know certain traders who just made a ton of money in the past 2 weeks through this volatility. Some of them allow me to put their feedback up, and I put that as member feedback. And some of them said, nah, don't worry about it. Don't mention it. Okay. So if I'm working at, and I'm no genius, I'll tell you that. All right. I'm goddamn good at these charts and understanding the game theory aspect, the political game theory aspect, and the human personality, of what's happening out there on the macroeconomic side, on the political side. But I have a lot of room to move, and using my charts to really reach peak performance of somewhere around maybe 80%. I'll get there. And all of you need to get there. Okay. On that note, let's take a look at the short-term chart, which is going to be extremely, this is it. This is the only chart you need to watch this week, to be honest with you. All right. This is your 15-minute E-minis. I called it Friday pre-midterms. This chart worked exactly the way it's supposed to be. Watch each of these supply-demand lines. Supply lines meaning where you have big sellers come in, and of course those are at the top end of the range. So watch the red lines, watch the green lines. You can see how structured this is in between all the manipulation, structured volatility. This was Friday put out there, and when each of those levels broke, they attempted to bounce. And by the way, this chart goes back to the 29th again. The 29th, okay? Remember I mentioned the 29th on the VIX side, where the negative divergence really started playing out. So with the VIX side, the negative divergence started playing out, and the market started going higher. So the VIX, the negative divergence that I showed to you guys right now, started to play out in between intraday volatility, and this started to rise. Now, through all this, lots of back and forth. So I look at this to manage my trades, to do what I need to do, and then I kept on looking at the extremely powerful daily picture. There you go. This is S&P Futures Daily to tell me that things are going in the right direction. I kept on saying, and before I go back to that chart, I kept on saying, and you guys really, I'm making it easy for everybody, okay? Believe me, I'm doing a lot of hard work on the background, scratching my few brain cells that I have in my head, and giving you a very accurate synopsis, because this playbook is no different than what it was in February and March. It's no different, trust me. Yes, the risks are higher, but the risks were higher at that time for that period. Okay? I'm talking about global macro risks, whether it be China, whether it be the Fed, whether it be earnings, whether it be the midterm election. So this one, as you know from my past video that you guys watched, the Kopak curve is still telling us we're going higher. The Kopak curve is a very powerful indicator. This is the beginning of the year. You guys know that by now. I said we would get towards the 50 Fibonacci retracement after a big crash. We did. We vacillated around here, and then there was this big downtrend line right there, which we broke out of. Okay? These are money charts. So I look at this as I'm managing my trades intraday, and this allows me to help me whether or not I'm going to stay with that swing trade after taking down some profits. And this gives you that mental, I shouldn't say peace. There is no mental peace when you're a trader. You always have to be on, moving, always have to be a bit stressed. No question about it. That's the nature of trading. This is not a walk in the park. Money doesn't just fall off trees. They start falling off trees like it has happened repeatedly at Clueless Trading, only if you are mentally and tactically set up to enjoy those big moves. Coming in after a 400-point move up in the market, you don't really make any money. In fact, you lose money most of the time. You all know that. So, saying all that, I take a quick look at this. I post it for you guys. You guys can set up these charts on your end just the way you wish, and I can certainly help you if you need some help. This is investing.com. Very easy on the eye. So when I started, you see this big, fat 600-point type of move, 600, 300, all that type of move on the Dow Jones Industrial Average. Well, it's telling you that there are big money coming in, and the stochastics, like I said, were a double bottom, and they did exactly what they were supposed to do. We will get some vacillation here, and maybe we'll get a triple bottom. Like I said, we could be down 1,500 points within the next couple of days. All right? And on the Dow Jones, of course. And but this will give us an idea of what the overall broader picture is. Broader picture. All right, so going back to this is the chart that you need to literally screenshot and and trade from an active trading standpoint. We have 2600 here. We have 27 on the upper end. We have 2770. Let's call it 2766, the previous 200-day moving average, which will be reset couple of points plus minus for Monday, right? Obviously, it's a moving average, not static. So saying all that, this is very clear. 50 fib right there, 2684. We could do that. Who knows? I don't know how the futures are going to open tonight, but given maybe they open down because of the pullback on Friday. So and then there was a big buy program that came in at 2 p.m. So all this is very clear on the eye. And just so you all know, investing.com is free. Just subscribe there with your email, and it's fantastic. It's fantastic. I use 3 different platforms, as you all know. I use Thinkorswim. I use investing.com. I use Quad, which is the Algo HFT platform. Phenomenal platform for predictive moves. And I use bar charts through Warden. I use 4 different platforms. And I show those, all of them, primarily these ones, and Warden, the TC2000, I show them once, sometimes. All right, so this is what you see. These are structured volatility patterns, so you cannot just look at everything, oh, that's a head and shoulder, blah, 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 because these things change really fast. All I know, it's a rising wedge. It got to where it should have gotten to, told everybody to sell at that point. Now we're pulling back, and the pullbacks are this is all mathematical. My son's a financial engineering major. I know somebody here who's attending, whose son is in the same major, and believe me, this is all quantitative finance, okay? All code. Call it regression analysis, whatever, it's code. And bottom line is that these Fibonacci retracements, it's all mathematical. Why do they always hit at those levels that, keep on showing? Because I'm some other great guy who knows? No, I just put this thing there. What I'm very good at pinpointing the reference points of how I'm drawing the charts, right? That's important. I could have gone back all the way and then, keep on going and say, okay, I shouldn't start here. I should start here. Well, then these charts wouldn't work like that. So so from that aspect, I'm certainly very good at that. And you can too. It's visual trading. So so saying all that, you got the 50 Fibonacci here at 2785. We could slip and slide. And remember, the slip and slides, yeah, we get those flash crashes, but and we got this flash crash, but even in between this flash crash, they attempt to stabilize at certain levels, primarily at these levels. And then, it's never like this. It's not like you got 2,000 points within like 2 seconds. You don't get that, right? Even when we drop 600-700 points, it's not like this. It tries to hit the levels, and then it goes. So it's the same thing going up. We didn't go up like this. We went up like this. That's why markets are not linear. Markets are algorithmic. Okay, so this chart is a very critical chart for you guys to track and trade this week. If we drop from 2723 to retest the 2600 level, excuse me, then we are looking at 123 point drop on the SPOOs, on the S&P 500, and so we are looking at roughly, on extreme level, we're looking at a drop of 861 points on the Dow. Boom, right? Can't happen. So make sure that you trade this chart, you look at this chart, and move on. This is your daily. I showed the daily. Overall uptrend is still intact. We have a green doji. Really means nothing. That green doji could be blood red first thing as futures start trading. We shall see. Or it could be a expansion candle like this, hitting the 200-day moving average again. Remember, this is the second level of the breakdown, all marked. The first level of the breakdown started here. Nobody expected this. It was still a bull flag for the days of 4th, 5th, 8th, and 9th of October. It was still a bull flag. Don't forget. Right there. Then, bang. And that's a massive flash crash for different reasons. Dollar went berserk. Interest rates went, velocity went boom, straight up. Like it was a perfect storm. And emerging markets just went in a tailspin. Equities got hit hard because of the peripheral selling that comes through. China markets went way lower, right? Remember the 3% days down? And then there was some stabilization. And a boom, huge rally. We played it. Then next level of selling came in. So these levels are critical. That's why I have big red arrows here. And we hit, and then they were sliding a little bit, and then boom, another one down. And that's where this is the first supply level where the sellers come in hard. This is the next supply level, 28.27, and 28.27 is way up there. Okay, and then you have the 28.80. Do I think we get there? Well, if there's a resolution, minor resolution on those things that I talked about, especially the China trade talks, yes, we'll get there real fast. There's an old thing when I was new to technical analysis, or at least devising my own way of looking at it. I always said one thing, and I still say it: every action has an equal and opposite reaction. That's Newton's law, Sir Isaac Newton's law of motion, right? And markets are, despite the emotional element of the individual trader, they are laws of nature. So this move here, which has scared $30 billion hedge fund managers. And there was a fantastic article that I put out there on behavioral finance, where this lady is getting calls from hedge fund managers saying, well, should I go long? Well, they should all just subscribe to Crude Estate Trading, honestly speaking. One day, and it's not going to be that long, we're going to have 1,000, 2,000, 3,000 people as members. I know it's going to happen, because you cannot be this accurate about the markets overall and not get the word out there. And that's the whole process of the online marketing with Instagram and such, because these calls are prescient. So going back to Newton's law of motion, if I do an exact pattern symmetry, then it's telling me that we are going to go to 28.27. Look at how precise this pattern is. It'll go up, it'll fall back. It won't be exact. Maybe it'll slip and slide more. Or maybe it'll even create a massive double bottom on the dailies. That's why I said the great news is ahead for people who sat around and did nothing. Overcoming fear and being a tactical trader is a process. It's not a one-day event, because I can't inject you with that mode, right? I can only encourage you and keep on seeing the results. You'll push yourself. You'll slap yourself mentally and say, that's it. I'm doing it the right way. No right or wrong way. I'm doing it the tactical way. Okay? And it'll get to you. One day you just wake up and just like anything else in life. One day you just get it. And your fear dissipates. I always say, at one point, it gets tired to be scared all the time, right? Doesn't it get tiring? Your fear is stopping you from making real money. And I'm talking to myself too. Okay? Doesn't it get tiring? Well, the people say, get rid of fear. Yeah, it's great to get rid of fear. You have real money on the table, right? And no. Embrace the fear. And work with it. Because this constant missing out of massive trades is debilitating to your confidence. It erodes your self-confidence. It erodes your P&L. And this doesn't matter if it's a bear market or bull market, both sides. Okay. So saying all that, if every action is an equal and opposite reaction, then we should get back to 28.27. And guess what? It'll most probably happen in between structured volatility, which I just showed. Could be slipping and sliding, possible retest of 2600, but one way or the other, unless things completely, and that's the real ugly black swan event, break down with China, interest rates, US rates go hog wild, higher, the Fed becomes really hawkish, meaning just wants to rate rates forever. Yes, they're not, believe me. If you read in between the lines in my comments, things have started to moderate. The inflation CPE deflator, which is the real core inflation part, has started to moderate. Oil prices have started to moderate. So if those things, emerging markets, there's no real blow up on any particular emerging markets. China shadow banking system, because they're very leveraged, right? Their economic stuff. I don't get into it right now. So something doesn't blow up. Of course, we can go lower on that note. Then it's a full-fledged ugly bear. All right. Now it's a tactical bear in play, and we're making money off that. So saying all that, given those type of serious black swan scenarios, this is what's going to happen. All right. But let's move on to the next chart. This is your 5-minute e-minis, and you can see the 5-minute. Trade this off the 5-minute. The 5-minute is a lot more candles, a lot more noise, right? Bear with me 1 second. Thank you. Yeah, so the 5-minute, a lot more candles, but it's also clearer to see. So in extreme volatility that we're dealing with, certainly keep an eye on the 5-minute charts. Certainly. And I don't look at the 1 minute because the candles are moving every 1 minute. It's a little bit too much. But you can do whatever you need to do. I'm just simply showing you what works very effectively for me. So you have the gap fill here. Guess what the markets did? So you can't make these things up. This chart wasn't drawn to satisfy and impress members and other people who will be listening to this video on a Sunday morning. This chart was constructed on Friday. On Friday. Even prior to me having to run out on Friday for a couple of hours. So look how precise it is. You have a gap fill here. It never really quite got there. You got the big move up at the following day, the gap open, right? This was Friday's gap open. I'm sorry, this was Friday's gap open. And what date was Friday? Friday was the 2nd, right? 2nd. Yep. So 3 o'clock, 9:50, you hit that level, the 200-day moving average, not shown on this chart, obviously, but so right there, and then I said there was going to be a pullback. Please go ahead and review that if you weren't really following anything on Friday, and you knew what the downside could be. You knew what the downside could be. Now I need to adjust this dotted line. I use the green dotted lines these days. Always have to adapt to the new circumstances. So the Fibonacci lines are here. See the 50 fib right there, 2710. So we hit that. We went below that. This was the only line that I drew at around 2 p.m. because I had 2 points of reference for my uptrend line. This was the uptrend channel. This is your uptrend channel right now, given where we closed on Friday, right there. Make this a little bit thicker to highlight it. Perfect. And then you have a rising wedge, which we fell out of at 10:15, right around the time I said short the market and take down profits. So you have this rising wedge in this pink magenta color. Then you have another rising, a larger upper end of a rising wedge right there, showing 2770. So again, this chart is also very important from a trader standpoint. Very, very effective. Look, I'm not going to tell anybody to do what they're used to, what their style of trading is. But personally speaking, if I can maximize my profits, listen carefully, guys. Okay, ladies and gentlemen, guys and gals. If I can maximize my profit in extreme volatility using tactical chart patterns and very precise levels and stuff that I'm trading off, I'm a pretty simple guy. I'm lazy in the sense that I don't want to complicate matters. Because that's the problem with retail traders. They overanalyze and then they're paralyzed. So I'm not telling anybody what to do. So I'm just saying it's my comment. I don't need to look at level 2. I don't need to look at block trades. I don't need to look at 10 different things. Okay? But you guys do what you need to do. I don't need to trade off a Thinkorswim script. My brain is a script and it beats the market consistently. So my point is that you guys certainly need to use your own skill sets, but if you incorporate these charts in the skill sets that you are employing or tools that you're employing, you will come ahead. No question about it. I'm not asking people to just follow my charts and just say, this is it, this is it. I'm simply saying it works very well. And you mix it in your skill, your tools, it's going to work very well because they're all correlated in a way. So that's the biggest piece of wise wisdom from a trading standpoint I can give you guys all. This is your daily of the S&P 500 going back to the beginning of 2018. That's why this big fat magenta line. When we went below 3 days in a row, 4 days in a row, below the break-even level for 2018, we were getting extremely oversold. We created a double bottom and a positive divergence where the prices went lower, but the internals went higher. And that positive divergence, as you know, if you read my Twitter feed, if you follow my Twitter feed, you'll know that played out big time. Let's move on. This is your daily chart. This is I'm going to put a weekly chart out there. This is your weekly chart. So I haven't done anything to this yet, okay? I haven't dressed it up for the party. So if you look at it, and I did ask that on the Twitter, I said, if any people should respond to me on DM of what they see. When you look at this pattern, and you look at the pattern symmetry, we had massive, this was back in 2018, right? Look. You got massive dislocation. Massive. I mean, I can't even, I keep on using the word massive, but this is just mind-boggling. Hammer reversal. Hundreds and hundreds of Dow points. Follow through. Another pullback. So if you look at this, we have had 3. Same type of magnitude, though, if you look at it, as in points. Okay? So you got this one could be this. It doesn't matter what the number of candles, but this was 1, 2 candle, and that massive reversal. So you had 1, 2, a slight reprieve 3 weeks ago. Then boom, the flush out, and then what we have here, unlike what we had here, can somebody identify what that is? What do we have here? Very, very similar. What do we have here, which is from a positive end, if you just look at candlestick dynamics? Because each candle worth billions and billions, $1 trillion, right? Yeah, it is. So what we have here, and I'm not going to wait for responses, is 2 hammer reversals with long tails. This was the longest tail. This was big. This was similar to this tail, the length. Those 700-point type of recoveries from the bottom after opening really ugly. But we have 2 here. We have 1 here. It's not a big deal, but things to watch out for. So bottom line is that when we look at this pattern here, we can see that we have a good shot of getting up towards that level here, which is a major supply level, and you could get some major volatility. But this pattern looks a heck of a lot like what is happening here. And you can see that very clearly. Tonight, I will show some multiple directional bias charts based on the New York McClellan oscillator the NIMO, as well as the SPX Swing 533. And those are pretty damn good. And there's some very interesting things in there that I saw this morning, which I'd like to share with my members. So if this did this, then we can assume that we have a move up toward the middle of November, third week, or maybe the end of November, and then we get another plop down. Then I'm just following this, not that it's going to happen like that. And then we get another big green candle, and then we get a big drop at the beginning of January. Okay, so I don't want to bog people down with too much stuff. The last thing I want to show is the E-minis going daily. Okay, this is your daily chart. This is the beginning of 2018. Here you can see it more clearly what is going on. I'm not going to make any assumptions, but this was a major bottom. Major bottoms like to be. This is a daily chart. Major bottoms like to be what? Somebody tell me. They like to be what? Not like to be bought. Yeah, we already did that. But a major bottom, in order for it to be a major critical tradable bottom on a more of a long intermediate term basis. You know how you say, oh, are we out of the woods? Like kind of stupid comments from the old days, but let me use that. Are we tactically out of the woods? So retested. Thank you, K-Bot. Thank you. Exactly. So the major bottom, in my opinion, will get retested. That's what the great news like. That's where you pick up these babies at the cheapest prices. And now that you have gone through so much volatility, now that you have gone through this fantastic guidance that Clueless Trading provides, your playbook is ready. Now remember, when this major bottom is retested, it will slip and slide. And that slipping and sliding is showing me 25.50. Now this being futures, that could be tested, that 50-point drop could be tested overnight Globex markets, and when you wake up in the morning, it moves from here. Whichever the case, that's the sort of picture right now, but the internals are not showing any deterioration till it gets up, overbought again. So is it possible that we bump up here and then create a major bottom? Absolutely. It is difficult to do massive swing shorts when you have the directional daily still saying higher. On that note, the last thing I'll tell you, whatever you guys do in this market, don't get overexcited on the long side or the short side. Have moderate to small positions, which get big because of the volatility. 100, 200, 300, 400% is not a joke. Take the 40, 50, 60% also intraday. Earnings, we have a bunch of them coming up next week. It's not as a busy week as last week. And there's some great companies coming up, which I'll talk about tonight, which we're going to play, including NVIDIA, including Splunk, okay, including Home Depot. We have a great choice. We have JCPenney. We have NetEase, which we always set up the trade. So we have Williams-Sonoma. And we have the pot stocks. We're definitely going to trade those. So we're going to talk a little bit more about the position sizing, however you guys want to do it on tonight's session. We have Canopy Growth. We have Tillery. And again, the last thing I'll tell you, which I truly believe in, our emotions, including mine and opinions, are worthless. When I get super bearish, the market goes up the other way. Trust me. Rely more and more on Clueless Trading, tactical formations, charts, precision alerts, and use your own skill sets, your own tools, and you will see the difference in your P&L. A lot more greener, a lot less redder. On that note, we'll see you guys tonight. Thank you for attending. God bless you all.